Hey everyone, I just wanted to make a quick video on how we enter on the next flip zones if we missed the initial chalk or if the initial chalk didn't get tapped, let's say. I know this week we had a little bit of tough PA, and I'm going to make a video following this, kind of how to play in the range, but just to stay on topic, we'll just keep this one strictly about continuations using chalks and flips. And the easiest thing to do is always look at the market for what it is. So right now we have a high point and a low point. Everything in between is substructure. So now if we're not breaking any structure to the upside or the downside, you're probably wondering, how do we navigate this and how do we know which way to go? One thing to make note of is if we just look at this high does not get taken. This low gets run. This high does not get taken. This low gets run. So what is our expectation for the market to do next if we had to just guesstimate? One of the things I'm going to say right off the bat is, to me, it looks like the highs are strong and the lows are weak. Now, this theory is a little hard to imply into this because usually we want a structure break for a high or a low to be considered strong. Unfortunately, our structure is located quite a ways away to the upside or the downside, so now we've been trapped in a substructure zone. So there's a couple of things to make note of. The first thing is I'm going to pull the most recent high and the most recent low, since we're just working within substructure and we're not actually working within the high and the low of our actual market structure. We're going to be looking at substructure breaks until the market either runs the high or the low, which it still hasn't done. It almost did, but not quite yet. With that in mind, we definitely know that this is kind of our zone we don't want to be playing in. And if we actually just take a look at what happens in this zone, it's all more or less stacked liquidity in the relatively equal zone. So if we just look at this, if we ran this high, or if we ran this low, I mean, this high becomes strong to a certain degree. The last high obviously ran the low as well. So now if we start looking at this logically, can we think maybe this is some form of inducement? Possibly, definitely. It's definitely something I consider. And obviously, this is hypothetically speaking. Like right now, we can say extreme supplies have maintained control. And as long as that keeps happening, we're going to keep looking for shorts. On the flip side of things, in the next video, I'll show people how to take longs in this same area too. So if we just look at this right now, we have some inducement built up. The next thing I want to point out is you have a bunch of liquidity here. If these little breaks right here, like, yes, you liquidated. Yeah, you liquidated here when with this. You liquidated this with that. If these were 1 minute breaks, I'd definitely consider the liquidity gone. Being that this is 15 minute, there's likely stops down here and it's not completely liquidated. Yes, you liquidated the guys that are up here, but you know damn well there's going to be stops down here. And there's also going to be sell stops looking to go down. So not only do we have stop losses, but we also have cause to go down. In case this low goes, all our breakout traders are going to be here with their sell stops ready to go. All our long traders are likely going to have a trade in here thinking this is some sort of a resistance or support that's holding, I should say. And there'll basically be a lot of resting orders in here. Something you can guarantee with the market is the algorithm does know where the orders lie, and it's always the flat spots. So flat spots will likely get run, flat spots will likely get run, and if you look at it the other way, this is a flat spot too. So with that knowledge in mind, something I'm going to be looking at is the flip zones. And how did these flip zones get treated? So here we have a demand zone that got taken out by a supply. This supply is yet to be mitigated, which is what we're coming into. Something I want to make note of is this low right here. This low, when it pushed up, it was not able to take this high. So even though we're dealing with substructure, right away, I have to make an assumption that this low is relatively weak and that this high is relatively strong. There's equals down here, lots of resting orders, lots of sell stops, stop losses, all that good stuff. So there's a lot of cause to go in there and take that. Now, being that we are bullish, I shouldn't say bullish, but we're in a bullish leg up, I don't want to just start selling immediately when I enter that supply zone. If that's your style of trading, that's fine. Just understand that you will likely take more hits. So what we push in the course is a 15-minute chalk followed by a 1-minute chalk. And no, it doesn't always do it, but when it does give you a higher probability setup. So now if we're looking at this logically, so your original tap into here, you definitely had a chalk and flip. We can mark it out. Could you enter that since we are unconfirmed bearish on the 15? Technically, yeah, you can. Is it the safest entry? Probably not. But if you can get your risk off quick, then I mean, all the power to you. I personally wouldn't take that. But I've really been about waiting for safer setups this time around. It's just the less losses you take, the less losses you have to cover. And you kind of have to find that medium zone where you're taking trades, but you're not taking stupid trades. So what I mean by that is if you're up a lot on the week and you want to try something a lot riskier, for sure. If you're down on the week or you're yet to take a trade, maybe do something safer. So let's just catch our 15-minute up here. So I'm just going to play this forward. So we're liquidating the highs right now as we speak. And we're just waiting for something that tells us we should go a different direction. So again, we have our chalk on the 15 here, which is roughly where the 1 minute's sitting right now. So once we have that, to me, that's some sort of willingness to go down. And again, we have that liquidity down there, and we have a weak low. Are the theories perfect? Do they work every time? Definitely not. Being how we're stuck in a range where supply keeps maintaining control from the extremes, I would feel better about shorting. And I know daily, the 4 hour is bullish on this, but the daily's bearish, the weekly's bearish. If I had to pick a direction overall, I feel better shorting euro than taking buys. And like I said, I'll definitely show in the next video how to take buys in this area too, as they're definitely valid. Wow, that took me a bit to find. Okay, so we get our 15 chalk here. Now, you don't really have much of an interaction here between buyers and sellers, so the expectation is to come back to the extreme where the order originated. And by the extreme, I mean, we'll just pull this back a bit. So now the supply I'm looking at is the most recent. And we can actually even take that and refine it a little more and just pull this wick. That to me is probably the most relevant area. So now looking at this, the first thing I want you to notice is how price stacked right here we have a bunch of trendline liquidity, but it's not just so much that we have trendline liquidity. Notice how price did this, and everything on the way up is mitigated. Well, if everything on the way up is mitigated, you have to ask yourself the question, why is everything mitigated? Right away, I look at it as trendline liquidity, and that BFIs do not want to be slowed down here, so they've mitigated everything for their future move, which is likely to do this. So on the flip side of things, if the market did something like that, and then it tapped into this supply, and you had all this gap of unmitigated little 1 minute demands all in there, and you had these gaps to fill. The only thing you really mitigated is this area, so everything else is unmitigated, and what that means then is the BFIs have a harder time to come through it. So it'll likely do this and this and this, and it's harder for them to come through it. But whereas if it's been mitigated, there's a lot less resistance, and it's just more or less there'll be a bit of a pullback every time a liquidity zone's hit. But seeing how every demand is liquidated, for the most part, it should just do that. There's no real intention behind this move either. Like, just looking at it, it didn't go up that fast. But yeah. We'll just play price forward here, and we'll just see how it acts. So right away, we get our liquidation up here. Now, depending how you pull changes the characters, and I'm very much about my wicks. You guys have probably noticed that. And what you're gonna find with the wicks is they'll work a lot, but sometimes it doesn't return to the original zone. So this is a chalk to me, how I view it. Whereas a lot of people would not view that as a chalk, and that's totally fine if that's how you view the market. We're all different. There's nothing wrong with that. And what I mean by that is a lot of people won't view the wicks I viewed as a chalk. They'll view that area down there, which is totally fine. Something I want to make note of, even if you did mark this chalk up here, myself, right away, my first instinct would be to put an order on this candle. That's the most relevant candle to me. The last one it's the candle before momentum, I guess is the easy way to explain it. So to me, if the BFIs came back, this little doji looking thing's likely to get tapped. If you're really smart and safe, you'll probably cover the high wicks. If you're a little on the riskier side, you may not choose to cover the wicks. That's totally up to you. The safe thing to do would be cover the wicks, obviously, 0.3 above or so. Now, if this is our next demand, something we want to look at is what causes this break. So, one of the things with Euro is it doesn't return all the time. Like, usually if it breaks the next demand and the next demand, it doesn't always return. And in the case that it does, you have to be willing to eat a loss. But as long as your higher time frame analysis is done correct, that's totally fine. So right away, the next thing we notice is we have a bit of a reaction point here, which is the gray candle, which is our pullback. So what took out the reaction point to me right away becomes this candle here. So right away, that's the next order. So myself, with where I'm wanting to take this, which is to me, if you're smart, you'll likely partial out down here. Maybe even take partials before that, depending how your tolerance is. To me, I'd likely hold to down here. If it's longer than a 1 to 10 hour trade, maybe pay yourself after 7-8 hour, take something off the table so you're not being greedy, because nothing's guaranteed. But this low should be target 1, and this low is also weak, so that would be the next target. Seeing how you haven't really broken out of this range, I wouldn't be targeting anything outside of that. Yeah, it's good to target this and that, but when you're stuck in a range, you got to be realistic with yourself and pay yourself accordingly. So, if we have an order on each one of these, you're pretty much covered. So let's just catch the 15 up a bit. And we'll play the 1 minute forward. So this would tap us into our order. Now, one of the things to view this is, this definitely could be inducement for the top order. So if we did get taken out of the first order, it is possible for it to come up top. It does happen. And it's just one of those things. You have to be willing to take a loss. Being how big this zone is, you gotta probably, cut it down. How big is that? Let's see. That's actually not even that bad. 2.2 pips if you take 25%. Let's say you even want to be safe and you take 2.5. That's still not that bad. You might even choose to go up a bit with this and cover this high wick again. I probably wouldn't, but it's not the worst idea to cover a little more. So you get tapped into this. We'll pull this trading tool down in a little bit here. What I wanted to show was the continuation opportunities you would have and where you would have them. So if we just catch we're just going to play the 15-minute forward a bit. So again, I'm going to play it forward a bit more. Something I want to make note of is the flip zones on the 15. So you have a wick here. And then you have sort of an area up here and up here. All these wicks stand out to me. So all these little wicks, they are a smaller time frame supply zone. They'll likely be something on like the 10-minute, 12-minute, 14-minute or something like that. And usually the way to view it is something happened in this area, something reacted, and there's a good chance the market will revisit these areas and possibly give you a trade setup. Something to make note of is you could see we'd be selling in discount. The only thing you have going for you here is you have a bullish, bearish engulfing candle. You liquidated the whole area. There's really no liquidity up top. All the liquidity is lying down here. So until that liquidity is gone, you really have no reason for the market to come up top again. And with that knowledge in mind, you could probably get a little riskier and scale in a few entries if you miss the first opportunity. And the continuations always happen in the flip zones. So just kind of, so again, you have these sell to buy wicks. Just understand that the lower you are in the leg, the lower probability it is. And a lot of times you'll become inducement for another move. And that's just part of the game. With that being said too though, there are scale-in opportunities on the 1 minute while we're going down. So if we're just looking at this logically, what happened here? Well, this would be a sort of a demand zone. And you took that demand zone. So if you really wanted to, just on that flip zone alone, we'll just call this a boss. This wick would be the demand, and the area that really broke this to me is this area. The area with the wick. If you want it to be a little safer, you could probably even take the top one. I'm just going with the most relevant area for now. Being how there is liquidity sitting up top, you definitely cover a little more, but that'd be another scale-in opportunity just because that's another flip zone. And this was our original 1 minute flip zone here. And if you actually look at it, where the boss happened, how it actually went down. This is actually the reaction point. And if we look at the most recent candle that took out the reaction point, that kind of shows you that's the candle you want to put an order on. Like I said, had you taken the top candle in that, you would have still got tapped in that, which is totally fine. That's just how I view the market. If you want to use the extreme candles, that's fine too. You won't get tapped in every time, but nothing is 100% guaranteed. So we'll just play this forward a bit. So you had multiple scale in opportunities here. As you can see, the original area never did get tapped. And that's just one of those things. Now, as this is playing forward, so look where this next scale in opportunity happened on the 15. It's actually 15 sell to buy wicks. And these sell to buy wicks ultimately get revisited a lot, and a lot of your scaling opportunities end up being inside these sell to buy wicks. So we obviously run the lows, but let's just play this forward. Here you have another flip zone. So if we just pull this zone as our demand, what I want you to notice is this is the reaction point. And I'm not going to go down on the seconds because we'll probably lose this chart and it'll fast forward. But what you can note is these sell to buy wicks, once again, we'll have a 30-second candle in here that actually took out the reaction point. And you don't need to go down on the seconds once you learn to trust the sell to buy wicks. There is something in there that caused that reaction point to fail. So again, low in the leg, but if we're looking at it realistically, this is a small order too. And if you're already in from the top, what you could do here is take partials. So if we're in on our first order, you're probably running, I don't know if I'd take partials quite yet, but you'd be break even anyway. If you're in on the second order, you're likely not going to take partials on it either. And both of these stops are a little bit large for Euro, I'm not going to lie. I prefer to have them 2 pips and under, but it's not always the case. With this here, you'll be able to scale this one in probably, let's see, so that's a pip. I would probably take a pip and a half, cover for spread. What I was going to say was if you really wanted to be safe and you didn't want to take a hit on this, if depending how you manage and stuff, this 6R trade here, you can just partial out 2R and worst case scenario, this loss is covered and you're up 1R on the day, your commissions are covered, so at least you're at break even. And at this point, neither one of these trades would have any risk on the table. So, just moving forward, and yeah, so that tapped a few times. Something to keep in mind, every one of these areas, especially like relatively equal highs like that, they can be an area of inducement. And as always, price can revisit the extreme. Euro's not bad, like it doesn't usually visit the extreme. On the pound pairs, you're gonna find that a lot more prevalent where the extreme gets visited. Or my favorite, the GU trade, that'll take you out of this trade and then come up here, wick you out of this one, and then it goes down. We have a love-hate relationship in that pair and me. When it's good, but it's definitely a little on the wickier side of things. So, again, you do have more flip zones. Would I keep entering? Probably not. Can you? Probably. You're getting kind of close to the bottom, and you're already, this last one already was a sell and discount. I probably wouldn't recommend it. The lower in the leg you go, the higher chance there is that you become liquidity. And like I said, if you look at any of these highs that are equal, a lot of times the market will come revisit and grab that liquidity. So nothing's ever guaranteed. Just understand that that can be grabbed. You did have another break of structure here. If you really want it to be a little on the sketchier side, you could take another scale in off there. Reason being is you had another demand here, and you really didn't have any kind of interaction between buyers and sellers. You can see price came right through. So you'd put it on the extreme doji. And no, I would never have this many positions on one trade idea. And usually I'll never put more than 2 trades on one trade idea. Because if it fails, then you put all your eggs in one basket. This is more of a visual learning tool to show people that you can keep getting in on flip zones. And obviously the lower you go, the lower probability it becomes and all that good stuff. Now, the good thing is we do think this low is going to go, and likely this one too. With that in mind, you definitely can get back in. You just have to understand that there's nothing to stop the market from doing that and then continuing down. So at least if you're in from this whole zone, the idea is you would have no risk on the table. And those trades are higher probability to go. But a lot of times continuations will continue, and it's just one of those things. Like I said, the idea is not to tell you to take all these positions, it's just to show you that it can be valid. Like again, you have a flip zone here, but with how low you are in the leg and you're almost at TP, it's probably not even worth executing. So let's just, so we'll say this is TP1, this low. And what we'll do is we'll make that show up on the other chart. So if that's your logical target, if you can't get a 5R to that target, don't be in that trade. Minimum 5R is what keeps you profitable. And if you knock off some 8Rs, 9Rs, 12Rs or whatever once in a while, it really makes up for your losses. Whereas if you start entering every 3R trade or every 2R trade, chances are it's not profitable in the long run. So what is the, if you entered on the top, even with the big stuff, so that's a 13R, 9R, 12R, 8R, like any of those is a great trade. And if you just caught one of them, that's a great day. Again, like I said, I don't want people taking 4 positions on one leg. That's just reckless. It's too much risk on one position. Usually what I like to do is get risk off the first, then maybe enter the second or partial out some risk to cover the second. And ultimately, you do hit TP here. Now, usually when a low gets run, especially a 15-minute low, you can expect price to bounce back the other way. So it's always good to pay yourself because you don't know how far that bounce back is coming. So what we talked about, how the lower in the leg you are, the higher chance there is that you can become liquidity or get induced in this example. That's a prime example right there. Had you taken another entry here, the only saving grace is you would have broken even on that trade because you would have been smart enough to break even once that low got run, probably take partials. But that is ultimately how you scale in on a position. Now, just to show everyone, so you can see we aggressively came through and we ran the weak low, which we said was weak because it wasn't able to take this high. So just from looking at what's in front of us, I can start building a story. So anytime you're low in the leg, just understand you'll likely become liquidity or inducement if you keep on selling. And that's why we buy from up top. So again, anywhere, if you bought anywhere low in this leg, you are likely going to become liquidity. So we'll cut this video here. I think I got my point across of how to scale in on the continuations of the flip zones. And yeah, I'm gonna, in the next video, discuss how to play in a range and how to do the opposite of taking sells, which are high probability and higher probability in this case. We're gonna talk about how we can get into buys and ultimately just how to manage a range, how to play a range. So yeah, stay tuned for the next video, guys, and hopefully see a bunch of you in the backtesting session tomorrow.